the technical stuff, please either to the email that you see here or put them into the chat to us that we can respond. But if you have questions and want to talk or want to engage with the speakers, please do that via the Q&A function. Here you can put in your questions. Everybody from us can see that. So Michael and Victor both can introduce them or can incorporate them as they go along. And you can also upvote the question that others are asking if you think they're particularly valuable for the discussion here. So given that the idea here is to, or that also the initial idea still stands, so both from the academic as well as from the practitioner point of view, this AI large language model is always some sort of like black box, and it's applied, but it's always the question sort of what can we actually learn, what are the advantages, but what are also the problems. And today we're going to talk about the use case. The paper title that Michael is going to present is ChatGPT and Corporate Policies. So we're talking about the questions, what can markets actually learn from managers, which I find a fascinating question, actually. And the academic today and the presenter is going to be, I say this in German, Michael Weber. So Michael is a long friend. He's at Purdue University. He's also a former Mannheim student, got his PhD in Berkeley, then moved to Chicago for the last 10 years, I think, and now just went to Purdue. His focus is on asset pricing, usually also inflation expectation. He talked about inflation long before inflation was actually a thing. And then, of course, when inflation actually came up, there was no conference where Michael was not the keynote speaker, so to speak, right? So thank you very much, Michael, for being here. And I hand over to you in a second. And then we have from the practitioner side, we have Victor Roos, who is at Rortrip Europe. I think he's going to explain a bit more what this company actually does. He got his master's degree from Erasmus School of Economics and actually then started at this company already about 8 years ago or so, starting in private equity and then moved to the public side of things. So thank you very much, Victor, for taking part in the discussion. And again, as always, before we start, I would like to start with a poll to get the audience involved. But now the technique is actually, here we are. So let me start with the poll. So the question is actually, the paper finds that ChatGPT's predictions of firms' investment plans align closely with CFO survey forecasts. Compared to human expert forecasts, how precise do you believe LLMs are today in predicting firm growth and innovation? So we have more precise, LLMs may capture signals humans miss, roughly the same, less precise, or not precise at all, far away from human level forecasting. So let's see what everybody thinks. And then I'm curious to see what Michael and Victor basically say, how they assess that. So let's give it a couple of more minutes, a couple of more seconds, sorry, to do that. Few more coming in. And 3, 2, 1, and all right, let's close. So this is the outcome. So 39% say it's roughly the same. Human expert forecasts are similarly good in prediction as the large language model. 30% say it's less precise, less than human forecasting. 28% says more precise, and 2% said it's not precise at all. All right, so is that something to you, Michael? Is this something that you would have predicted, or is this something where normal people say, look, this is a computer, this is a machine, they should be better than humans in doing that?
I think it depends a little bit. Now I'm the academic perspective on the one hand and on the other hand. So that's why we always have two hands. So like I think, in kinds of more stable times where actually we kind of indeed can exploit lots of information that is out there. I think it's kind of like, I would argue most likely better than most human forecasters, but it might have a hard time to actually capture structural breaks. And I think that's still something kind of like where kind of humans might have an edge, but even humans kind of oftentimes miss those structural breaks. If you think about the Federal Reserve kind of talking about inflation being transitory way into kind of like the inflation surge, and the Fed only being active kind of like after Powell was reconfirmed in the Thanksgiving week of 21. So in that sense, like, I think like humans can have an edge when there's lots of terminal structural change, but even there, like oftentimes human forecasters actually do a pretty poor job. So like, I think it depends, but they do have an edge in many situations, LLMs.
Victor, over to you. What do you think?
Yes, I think especially when it comes to, let's say, factor investing, it's also much a question of depth versus breadth. So, of course, an LLM, it can analyze quite a lot of these earnings reports, especially if a lot of them come out at the same time. If you would do that with humans, it would be hard because it's not standardized. You would probably need a team that is very structured to do it in a standardized way. That means there's a big use case for LLMs in that environment. Of course, I would say if I read it, of course, I'm kind of biased. I have high hopes about myself. But if I would read an earnings call myself, I'm hoping I would do slightly better than an LLM. But to be honest, I think most even academic research says that even simple base rates happen to outperform humans sometimes. So it's better to take a humble approach, I think. And these new LLM developments are certainly very interesting.
Perfect. All right, then let's see what the LLMs actually can do and how they perform. So maybe we can start with Michael, and I look forward to learning more about how you can actually and whether the markets can actually learn from managers. So Michael, over to you.
Okay, fantastic. Can you see my slides?
Yes.
Okay, great. First of all, Sasha, Birgit, and Paulina, thanks a lot for the very kind invitation, and Sasha for the way too kind introduction. So today I want to talk about some work we've been doing with the three super kind of skilled and great co-authors, Shanlin, Manish, and Bao Song. And so like, if you start off from a bit more of kind of an academic perspective and kind of think about, okay, my colleagues in corporate finance, they oftentimes want to understand corporate policies, being at leverage, being at investment. So I come a bit more from the macro angle. For me, kind of like understanding aggregate fluctuations is key. But, if you want to do that, of course, also firm investment is the key variable to focus on because it's kind of like the most volatile component of aggregate growth. But now if you would take on a theoretical hat, like you would say, well, actually, I don't need to do anything but to observe Tobin's Q, because under standard assumptions, like that's a sufficient statistic for firms' investment. Now, of course, since the famous and celebrated Hayashi paper, like, people have shown over and over again that maybe Tobin's Q is not sufficient, potentially because of financial frictions, measurement error, and so on. One angle that we want to focus on is the idea that maybe the market doesn't have all available information, and the managers potentially could capture part of that private information that they potentially then can convey to market participants via scheduled earnings calls they do once a quarter. And like, here, I guess Victor already kind of like motivated our paper, while potentially we as researchers could read all of these reports or maybe do some kind of basic kind of dictionary-based approach, a la maybe Look and McDonald. Like obviously, like it's not really scalable, might actually miss important aspects. That's kind of like where large language models come in and potentially can give you human-like answers for like long, complicated, sophisticated text at scale. And so effectively, that's what we're after. We want to understand whether like large language models can understand corporate policies as conveyed by corporate management, whether this kind of like extracted information helps us understand future realized firm investment, conditional and standard determinants, including Tobin's Q, or maybe the alleviation of constraints like cash flows. And then also potentially the asset pricing implications if you think about some production-based or like kind of investment-based asset pricing models. So like, just kind of as a teaser, like in the aggregate, we start in 07, we end at the end of 20. And all we are doing here, we are plotting what we extract at the firm quarter level, aggregated across firms or averaged across firms over time, and then look at subsequently realized investment or capital expenditure. And what you see actually that, what managers say today is actually in the time series very strongly correlated with subsequent realized change in capex. And so like now in terms of like additional findings, like, of course, whenever you do such an exercise, you first want to kind of like validate your measure a bit. We want to do that in different ways, including comparing it directly to what CFOs say in the Duke CFO survey, drill a little bit in the cross section for which type of firms actually this predictability is there, for which type of investment, and also link it to stock market outcomes. So like just in terms of like data, so like we directly download all transcripts for earnings calls between 07 and 2021 at the end. From Seeking Alpha, we merged it at the firm quarter level with the Duke CFO survey, standard financial and balance sheet variables. And so ultimately, think about a data set that has like roughly 75,000 quarterly firm earnings reports, and for roughly a little bit less than 4,000 unique firms. Now, of course, like, big input in our analysis is the prompt that we feed to ChatGPT that we use for our analysis. And so like, what we tell them is kind of like, take this text only and answer the following question. How does this specific firm plan to change its investments? We tell it that there are 5 answer options, from increase a lot to decrease a lot. And then we also tell it that the answer should be in the format choice explanation. And if there's no discussion of like capex, you should directly say no information is provided. Now, we wrote that paper already a couple of years ago. At the time, it was still state of the art to have ChatGPT 3.5. Even from a perspective today, it's actually useful because I want to come back later on to a truly out of sample analysis. And for that, you need to have the training information and material to end before the actual sample. So I come back to that later on. But that also means that we needed to cut our earnings text into different chunks. And then we assigned numerical values to the answer options. And then for our baseline measure, we just average across all scores that ChatGPT assigned to an individual chunk. So think about like, a given earnings call has 4 chunks. We then just average for a given firm quarter the 4 scores at the individual chunk level, across the individual chunks. Now, of course, it's an earnings call. Most of the time, we'll talk about earnings, we talk about future sales. There will be discussion between analysts and managements, and you see that roughly 3/4 of the chunk, there's no discussion of capex. But then once you actually aggregate to the firm quarter level, you see that in roughly 50% of all observations, you have like a numerical score, and it's roughly kind of equally in the negative and positive domain. But is the score actually any meaningful? The first way to look at that is to kind of just look at chunks of text that ChatGPT tells us should be associated with lots of positive capex or very negative adjustment in future investment. Just see kind of a bigrams what the text is all about. And you see like when ChatGPT says that it's a firm that will cut investment, you see indeed it's a discussion about cost reduction, we want to substantially reduce costs and so on. Instead, actually, if you focus on firms that ChatGPT identifies as, in the next 12 months, they will actually want to increase a lot their capex. You see like revenue growth opportunity, capital expenditure. And so like, that already seems to be quite plausible. We can, of course, do more. We can also actually directly, this of course, like, carefully hand selected, so I don't want to oversell that here. I look at kind of chunks that actually are very positive or very negative. And here, for example, I have bolded to kind of look at the key things like, sustained growth, significant capital investment. Instead, for negative scores, CapEx will be down a lot. Now, how does it now look like if you look at the across sector over time variation? Again, maybe actually seems plausible with what we would have actually maybe thought. Like if you look at the Great Recession, retail, mining and construction, very dark blue, which means very negative kind of ChatGPT investment scores. Then let's zoom in maybe at the beginning of the COVID-19 pandemic, software, biotech, healthcare, pharma, kind of colors that are associated with very positive scores, relatively speaking. And again, maybe quite plausible with what our priors might have been. Now, a different way of kind of saying, well, is this actually what ChatGPT tells us? Any meaningful and reflects what actually the management itself aims to convey to maybe the broader markets. And so here we take advantage, and I think that that's kind of like what I'm pretty proud of, and I think what sets us apart in relative to other papers is that we can directly actually compare what management itself says, what they plan to do, because we have access to the micro data from the Duke CFO or the Graham Harvey CFO survey, and they directly tell us, whether they themselves plan to increase capital spending a lot over the next 12 months. And so what we can do, we can now simply bin firms based on the current ChatGPT investment score and then match it to a subset of the firms for which we have the Duke CFO survey to then see what management themselves says. And here we see that, if ChatGPT identifies firms as having a very low ChatGPT investment score, those are also firms that in the Duke CFO survey say they want to cut their investment on average over the next 12 months by roughly 8%. Whereas those with a very positive score, they actually want to increase by more than 10%. So also quite strong monotonic association. Okay, so that's first kind of like, is it plausible? Maybe it seems to be quite reasonable. Now what we want to say is like, does it help us in understand future realized investment based on balance sheet data? And so like we run a very simple regression in the quarter, after the quarter in which the earnings call happens over for the last quarter. So that's why T+2. Let's regress at the CapEx over the next 12 months on the current ChatGPT score, current Tobin's Q, like lagged capital expenditure given its persistence and standard controls, firm and time fixed effects, and then see whether our investment score has predictive power. And like, without going into too much details, both in the raw data, once you have Tobin's Q, and once you saturate the specification with additional covariates, always directly adding firm and quarter fixed effects, you see like, there's a pretty strong correlation between the investment score and future realized investment in terms of like economic magnitudes. It corresponds roughly to 2/3 to all the way 100% almost of the sensitivity of Tobin's Q with future CapEx. This is not a short run phenomenon, but you see in fact actually that there is this association, given it's also maybe plausible. I only talk as a CFO about capital expenditure in my earnings call. If I plan to implement a huge investment, building a new factory in Lafayette or something along those lines, you do see the predictive power is actually quite persistent and then funnels off after like 10 quarters. And in terms of like, which components of investments do we predict? The questions about capital expenditures, like naturally the effect is strongest for physical investment, but you also see explanatory power for intangibles and R&D. Now, if you step back for a second, like, what is kind of like the theoretical underpinning behind the Tobin's Q-type logic? If my cost of capital is expected to be low in the future, more projects become profitable, and so therefore I should invest a lot. So therefore, investment-based asset pricing theory would tell us that if we are indeed able to forecast future investment, that most likely should also signal lower future realized returns based on this kind of investment-based asset pricing logic. And in fact, you see that higher ChatGPT investment score, given it predicts higher future investment, also is correlated with lower future realized returns, both raw returns and factor adjusted returns. In terms of like magnitudes, that's quite sizable. The 1 standard deviation increase in the score results in about kind of 1.5 to 1.8 percentage point lower future realized returns. Now, if you now, however, like take this idea and put it on the flip side, if I now have a variable that predicts, and it's new information, lower future expected return, that means given the stream of cash flows that I forecasted and nothing else happening, it should also mean that if I discount those cash flows now with a lower discount rate, the current market price should go up. Or saying it differently, around the announcement, I should see short-term positive realized returns. And that's what you see, like the cumulative abnormal return from the day before the earnings release until a day or 3 and 5 after is actually quite positive. And that's true even if you condition on the generic sentiment that has been shown to be correlated with the announcement return, or if you directly condition on the earnings surprise. Now, if you now think about it, imagine like I'm running like a cash cow or like a dog, I'm very late in the life cycle. On the one hand, I might not invest in the first place, but there's also very little that the market doesn't know about myself as a firm. Instead, if I'm the new kid on the block, but there maybe not many analysts are following me. Maybe it's really unclear, what my business model is, how the demand for my product is evolving, and as such, like, how much I plan to invest. So all I'm trying to say, there could be quite heterogeneous predictive power for the score for future realized investment. That's kind of what we want to bring to the data. So like the first thing I want to show you here is that indeed, like the ChatGPT investment score has kind of a stronger predictive power for smaller firms and firms in more competitive industries. And similarly, I think, some of that work, or like at least the authors were in previous editions, like if you use the Hoberg-Philip measure of kind of like, where are firms in terms of their life cycle, you do see like, if firms are in their early stages in product or process innovation, then you see very strong predictive power. Instead, there's no differential predictive power for firms that are in mature or declining stages of their life cycle, so life 3 and life 4. So now what I want to kind of like do before briefly then kind of wrapping up is kind of the last thing, if what management says is indeed telling market participants what they plan to do about future investment, the main listeners to those kind of statements should also update their information set and accordingly their forecast. So what we do now is actually like, after the earnings call, do analysts change their forecast for future capex relative to before? And indeed, like, positive ChatGPT investment score positively predicts changes in the positive direction for future analyst forecasts. Now, in terms of time, let me just briefly mention, and this surely kind of then will also be part of like the conversation we have afterwards and Victor's discussion. Like, so far, everything I showed you, you could say, well, look, Michael, even though you kind of told ChatGPT only focusing on that specific text, it knew the reality that happened afterwards. And maybe like, that's kind of why it works so well. Now, and that's where kind of like our specific version of ChatGPT comes in nicely. Can of course only use data that actually materialized after the end of the training period, and then redo our very same exercise for like the data we have after this period. And what you see here, even when ChatGPT didn't know the future, it still actually extracts meaningful information. And so like the last thing just to allude to, like, you can also, of course, kind of remove any identifiable information from the text to do like a masked identity text. It still kind of like results in very similar answers. Like I skip, all the things that you need to do if you write an academic paper, all the robustness and alternative measures and so on. And let me just kind of maybe stop here and then look forward to Victor's discussion whether he sees any value of what we do academically also for practice, or maybe whether it's all in fact useless. So like, let me stop sharing and hand it over now to Victor. Thank you.
I definitely do not think it's useless. I think it definitely has a very practical side to it. I have to say, I also think that the paper itself also is relatively practical. I'm not sure if that is a compliment to an academic or not. Maybe I should put it different way. For a non-academic like me, I was still able to get some idea of what I was reading. Which is not always the case. So that I count it as a positive thing. Let me just quickly go to the first slide here. So I guess for practitioners, really a big question is like, can we, well, to make it really simple, can we make money with the ideas that were just discussed? And before I dive into that, I would want to take some time to first of all, to take maybe a small breather for the audience, but also to point a bigger picture, because what we're really doing is we're looking at characteristics of companies that we find attractive. And I'm pretty sure that people, especially from the asset management side, they will be very familiar with, of course, any information from the sheets. So balance sheet, profit and loss, you know it. Sentiment type of data, probably also alternative data sets. And for a lot of asset managers, I think the question really is when is the time to really dive into, let's say, a new field like LLMs? When is it worth investing your money, maybe building the infrastructure? When do you really want to go for it? And to already give you my answer to that, I would say, even by just reading this paper alone, but also, of course, reading information from other sources, I think it's really about time to start now. Then I actually wanted to reiterate some parts of the paper, and then definitely put a focus on, how can we apply this in practice. And of course, one of the core ideas that, especially if a practitioner would go through the paper, would definitely focus on the one hand, the short-term trading signal that is described, and at the same time, also the longer-term factor that is described in the paper itself. What I also found really interesting, that goes for the paper, but also in general, is that even using Seeking Alpha's earning call data, you can get pretty robust results. And actually, my question to Michael would also be, how did you get the data exactly? Has this been like a scraping process? Were you able to get it in another way? Because I think for the audience, it might be relevant, especially maybe some of the people in the audience that are thinking about tipping their toes into this side of factor type investing. Whether this could be maybe a first step, because acquiring a data set maybe from one of the big data providers can be expensive, while this could be maybe a more affordable approach. Michael, do you have like a small chip into that?
Yeah, no, totally. So like, I took a note. I wanted to come back to that later, but I think indeed, like in the spirit of like the webinar, kind of like, let me directly chip in and make it a bit more interactive between the two of us at least. Yes, no, indeed, like that's a great point you raised, Victor. You can actually directly download all those transcripts in bulk via the API. So like that's something like you don't need to kind of do one by one, or like, find other ways. That's kind of like pretty straightforward. And once you have it, you can use the API for ChatGPT and directly then kind of feed it in. Now you don't need to do the chunking process anymore. if you use a more recent version of ChatGPT or other kind of large language models. But like, as I mentioned, at least for an academic applications where you always need to kind of prove that like there is valuable information out of sample, like, from a practical perspective would be more like, can you actually make money? And so like, the true out of sample is maybe not relevant. The true out of sample is your bottom line at the end of the day.
Okay, thank you. That also brings clarity to my side. Like Michael mentioned, especially also when you look at the development of these natural language processing models, it used to be the case where you would have to do a pretty complicated stuff in maybe a programming language like Python to get the results you're getting. But especially nowadays with ChatGPT, maybe you can use other type of LLMs. You can just use their API, and it's actually pretty accessible to a lot of people in the industry. Well, some parts here have clearly already been discussed. A couple of example corporate policies, maybe looking at capex, looking at dividends, looking at the number of potential employees in the year ahead. And what is also becoming more easy in general is like you have so many examples nowadays of prompts that you can use. So where maybe even 1-2 years ago you were all on your own, this information is becoming more and more public, where even in this paper you can see first there's a clear description in terms of the text. Afterwards, you clearly note that you do not want any other data than let's say the earnings call or the 10K if you use something else in your output results, and limiting the choices that an LLM can give also can greatly limit the potential for hallucinations, which I also think is a great thing, and I would consider that a standard in terms of making these prompts. Then when it comes to robustness checks, this also is becoming more and more available, and some of them you can clearly see in the paper. So for example, taking some sort of baseline, you could say, so in this case, this was the Duke CFO survey, where you can actually see like, is this data that I'm using, is that does it really make any sense to have any kind of baseline like that? I think also in terms of practicality is really big. Of course, I've listed a couple of others here. You have the human validation aspect to it. I actually thought that what was interesting was you just mentioned splitting text in multiple parts. Sure, it can be a limit of an old model, but you could also consider it a bit of a robustness check, because you kind of spread out the signals, you could say, over different parts of the text. So I really like that type of idea. Then the out of sample test, as discussed. I think different LLMs also is becoming way more approachable and affordable to practitioners. So of course, I think if you're a big firm, you might want to actually build these systems in-house because it will give you slightly more control. But especially if you're starting out, or you want to make a base type of a model addition, then these ready-to-go LLMs can really prove very effective. Of course, different data sources. I don't think that is specific to this specific part of factor investing. That is always the case, but still a very important one. Some of the other ones that I've personally experimented with is to see if I can change different parts of the text, move them maybe up. So for example, if you have like a Q&A in an earnings call, usually it's on the bottom, you can move it to the top. See if like these very small adjustments, they shouldn't make any real impact on your output. You could maybe limit the amount of text that you actually use. Maybe you only want to use the input of certain speakers, not of all of them. And actually varying the sizing of the chunks that you're using. If you use chunks, actually, I think is also a pretty good robustness check. So these ideas are becoming more and more available, which makes it so much more approachable.
Victor, maybe in the spirit
Yes,
of
yes.
interaction. So like, I just thought that was kind of a super nice and interesting idea, and I hadn't seen that kind of attempted by anyone. So like, trying to see whether who says what makes a role, because like, as Sasha alluded to at the very beginning, that, I've done quite a bit of work in the context of monetary policy, and there clearly you do see that, at least in the US context, like, whether it's kind of like one of the triumvirate, like chair, vice chair, or New York Fed president, makes a huge difference relative to like any other governor or like voting and non-voting FOMC members. Like similarly here, it could actually be quite interesting trying to tease out, like, when it comes to investment, maybe the CFO is the person to listen to, but maybe when it comes to something else, it's a CEO. I have no idea, but definitely want to echo that it's a great point.
Can I add to that, or ask basically the earnings calls have been used quite a bit in research also, right? Also not the Gen AI or AI models, but the machine learning, biograms, textual analysis, and so on. And they particularly the stuff, for example, like on climate change, what's been done by Zach Zautner and his colleagues, they always were very clearly focused on, okay, we need to look at the Q&A part, right? Managers don't want to disclose that type of information. They need to be probed a little bit in order to give that. Does this play a role here, or do you differentiate between, do they actually, I mean, if you're arguing managers want to convey information, they need to prepare the remarks actually to do that. If they are forced to do that, then it's going to be in the Q&A. Is that going to play a role?
Like, we haven't specifically looked into, but I could see that maybe positive news, so like positive scores, are more likely in the prepared remarks, whereas like negative ones, especially if they are more firm specific, could come out more in the Q&A part. Now, if it's 2008 or 2020, 21, I think kind of it's natural that management talks about slashing and cutting CapEx, but once it's more like in 2015, firm specific, maybe that part could be more in the Q&A section, but we haven't actually specifically looked into that. But I definitely can see that this is something in line with kind of what you said, Zach and others have shown for like kind of the green part.
A second thought that I had that's likely less relevant from the practical side, so I don't think that, Victor, I'm going to step on your toes here, but Michael, you said also that the technology is moving, right? You said you don't need the chunks anymore. That's the ChatGPT versions, the new ones, even the 3.5 Turbo, what's this called, can basically handle the whole earnings calls. From an academic perspective, is that an issue actually, that the models are developing, that it becomes a little bit more maybe difficult to completely replicate the things that you've done in earlier models, that the full version is different compared to what the chunks actually do. So is there any kind of issues here, or is that completely irrelevant for academics also?
I think, like, as you allude to, like, certainly there's been, especially over the last decade, now a big push in replicability. And so, like, let's say the paper is published, you will at some point need to kind of share code and data to the extent it's shareable. And so there you need to be very clear, like, which version, but even like previously, like, which version of Stata did you use? Because like the packages that come with it were different potentially. And so similarly here, you need to be clear in the description, kind of like, which version of ChatGPT, what's the temperature, what's the prompt, and so on you are using to ensure replicability. However, sometimes that's actually not even enough. Think about kind of like rewriting history in the sense that CRISP and CompuStat over time changed the publicly available data. Now, I haven't seen yet a way to address that, given that you can, of course, not share like, commercial databases in publicly posted code. And so definitely the vintage of the data you're using does play a big role. Now, in terms of like more generally kind of coming to your point in terms of like, different versions of ChatGPT, for example, like, there kind of, certainly like maybe the score hopefully is becoming even more accurate, more informative by having kind of maybe more text that was trained on. At the same time, this is part of like, the penultimate slide that I was skipping. You want to already show robustness, you use alternative large language models and show that it's not just because I was kind of maybe engineering the prompt sufficiently on that specific large language model that I actually did find desirable results, but you want to show it's actually kind of with slight variations, how you aggregate, how you kind of which LLM you use. And so in that sense, like, you know, I don't think it is an issue that with newer versions, like things might be slightly different, but, you know, in a kind of a bigger scheme, like, you know, you need to be replicable by being transparent in what you actually used when you wrote the paper at the time.
And the interesting part of it is that this development in academics, where you have to be a bit more transparent, that is actually also kind of nice for people that are, let's say, more from the practical side. But because you don't want to know, like maybe 5 to 10 years ago, you could read an academic paper, but just have maybe a really hard time replicating it. There was just simply no way of sort of copying any type of results that you see. I'm not saying that you can always now get it straightly from the academic, but also these LLMs also allow you, that's of course a different topic, to make it easier to replicate results. Yes. So yeah, great developments, I think, both for academics, but also for practitioners. So maybe I can go on with where I was. Yeah, I think if you put it a bit in historical perspective, I think we already touched upon this. If you look at where we came from, I mean, quite a long time ago, you would use maybe data from the income statements, maybe some price data, and that was it. When it comes to sentiment type of factors that you would be using, maybe you would look at specific words only, maybe the words that you actually saw in the cloud, that like in that cloud diagram that Michael was just describing. But nowadays with LLMs, it's also just a tool to sort of augment these factors that we already have. So in this case, a sentiment factor. Same for momentum type of factors. It used to be the case where you would only look at maybe past return data. That is kind of a bit of a primitive approach. We can definitely augment those factors. Actually, one of the factors that we have been working on internally at the family office that I work for is actually also kind of corporate policy related. So we've had factors in the past that looked at the number of acquisitions that a company has done maybe in the past 3 years or 5 years, and also looked at the size of these acquisitions relative to the own company size, whether that is sales, assets, or market capitalization. And within that universe, if you look at that universe of companies that actually do acquisitions, one of the things that we found and also used in practice was that companies that actually have a lot of experience and do maybe a lot of acquisitions into companies that are relatively small, those do usually pretty well. Well, I mean, it kind of makes intuitive sense. Companies that maybe hardly have done any acquisitions at all and start doing a really large takeover, those might not be the best investment. Well, you can do that a bit with maybe cash flow statement type of data by looking just at cash flow out for acquisitions. You can get a rough approximate. Of course, you can add like specific M&A data sets, but now with the LLMs, you can really augment those type of factors too, which I thought was kind of funny. That was, I think, one of the corporate policies that was not part of the paper in the robustness check section. So I would definitely be looking forward to that one. Yeah, then in terms of influence on asset management, I think it's also kind of a sort of summary that I would give is to say, well, with these LLMs improving, I think this has also already been mentioned by Michael. Of course, if I would have to bet whether these results will improve through time or will stay the same or become worse, then I would definitely bet on it becoming better through time. So that also makes it more attractive to build the infrastructure, because if you have the infrastructure in place, then with the development of these LLMs, more likely than not, your results will also improve over time just by you building the infrastructure now. And then, of course, I'm not even mentioning the fact that there's more and more types of data that's maybe more qualitative and less quantitative. You really want to take that LLM approach into account in that case. And more importantly, I think it will also really help people in practice. That is more like a political thing, but I think it's still good to mention here, is that when academics can validate certain ideas, that actually also usually makes it easier for people in practice to maybe, use some funding to get the new data set, or to get to start using these new approaches, because this is not always trivial. You can have a great idea, but to apply it in practice, you need also, let's say, the board or the people above you to believe in it. And usually it's not the head of research that makes these decisions. So unfortunately, yes, I think big developments coming up, and it's becoming easier and easier to justify these increased or these costs for building the infrastructure. Then I actually had like a few little remarks that I kind of put on the slides, just going through the paper, Michael. I think a big one for me was when it comes to the seeking alpha data. I was wondering, like, I mean, you most likely you will have some data that is lacking from firms that maybe, I don't know, got delisted, or is this like have you looked into this? Has this been maybe like only a small proportion of the total companies in this case, or just as a general idea, especially also maybe for the audience, if they think about, I also want to get started at least with some data set, and they're thinking of maybe using Seeking Alpha, or I think there's also the Motley Fool, and you have a couple of others, people that provide something that looks like what you also used in the paper. Do you see this as a problem at all, or is this something that is kind of negligible?
Yeah, of course, like whenever you do this analysis, and this goes back a little bit also to like the discussion we had previously with kind of Chris Compus said, like, you have to be cognizant that potentially there's survivorship bias. Now, if you kind of like, you are in the here and now, and you want to kind of start getting your hands dirty with this type of analysis, like, you want to think about your investable universe. And now, of course, for that, kind of the firms that are currently listed, that currently have earnings calls, are the ones you want to analyze. Now, my understanding of Seeking Alpha, and I would need to verify that, like, if a firm was publicly listed 5 years at the earnings call and then got delisted, that earnings call should still be in our data. Now, of course, it means that if we do like the forecasting regression of CapEx over the next 2 years, like the outcome will be missing. And so that then it disappears. In that sense, like, wouldn't be able to now exactly do like a delisting bias corrected, like a forecasting regression for CapEx. Like sometimes what people do, at least for future returns of firms that got delisted, they do this delisting adjustment a la Schumway, which of course is also rather imperfect. I think from an academic perspective, like, that's potentially a little bit of an issue if you have like a subject to a delisting bias. And again, I don't think actually we are currently subject to that, to the extent only, however, that some of the outcomes will be missing for the longer term, of course, yes. But from a more practical perspective, if you want to kind of like implement like what we do, kind of forecast current investment in the subsequent 4 quarters, I think, that's exactly the universe you want to look at.
Right. I actually also, while you were talking, I actually also had another question that is not listed here, but it is actually also important to me in practice. I think you mentioned that if you look at the effectiveness of the investment score on, let's say, future CapEx expenditures, then that works more effectively for small firms. Do you think that will one-on-one translate, or maybe not one-on-one, but at least to a large extent, also for, let's say, the return regressions that you ran? Reason I'm asking is that smaller AUM firms will most likely also invest in smaller stocks. So that would make it even more beneficial for them to maybe start using these type of models.
No, yeah. So like, I should be careful because we haven't done it in that context, but I would assume that indeed also the predictive power for returns is stronger for smaller firms. Pretty much anything I've personally looked at in my asset pricing work tended to work better for smaller firms, which oftentimes also means like, you get issues with referees because they say, well, if you do value weighting, why would we care from an aggregate perspective? But, from a practical perspective, if you kind of have like anyway a smaller kind of focus and scale because of like maybe a smaller AUM, then in fact, actually, maybe it's indeed more interesting, even if it would work stronger for smaller firms. So like short answer, we haven't done it, but my hunch would be that consistent with like the CapEx regression, it would be stronger for smaller firms.
Right, that makes a lot of sense to me. So maybe the final one for me before we move to the audience. Like I was kind of wondering why I think CapEx was definitely in the regressions for future CapEx, but it changes in CapEx in the past was not part of that regression. If I'm making a academic blunder, then please also point that out to me. Like for me, I thought that would be intuitive to do also. Oh, the mic.
Maybe I should ask ChatGPT to handle my mic. No, that's a great point. So like, we did control when we looked at changes in CapEx for lag CapEx, given like there was so much heterogeneity. We also played around kind of, is it better if you lose changes in CapEx, more lags in CapEx? In the end, actually, it doesn't make a difference, but, it's a good point. We could actually just also report it. Like I think in some appendix tables, we have additional controls also. Not sure whether asset growth, change in total assets is in there, but that's certainly something we can add indeed.
Can I jump in? I have a couple of questions actually to both of you, but Michael, maybe I start with you. So normally, I mean, managers don't disclose information until they get something in return, right? So normally you don't give it away, you expect something, right? So why do managers do that, right? They don't care about people making money based on that, getting something, the stock prices. You said something about sort of analysts incorporate this, but sort of what is sort of the manager's intuition by carefully planting this type of information?
No, totally. So like, one of the big purposes of those earnings calls, and of course, is partially in looking at the rear mirror, discussing kind of what has happened, but then of course also like guiding market participants via analysts, kind of like about the future outlook of the firms, both in terms of sales but also investment. Because like, what managers really don't like is kind of like disappointing the market and then having large negative earnings surprises and return reactions in the future. So in that sense, that's just part of kind of managerial guidance to ensure like, there's no information asymmetry / big surprises going forward. And which of course then, if you have a large negative market reaction, that's maybe also negative for your own pocket or wallet, because that might make actually less likely for your option grants to be vested and stuff like that. So in that sense, it's just part of like, managerial guidance. At the same time, this goes back to our discussion from previously, and we haven't done it. It would be interesting to see like, whether there's this asymmetry of having like a higher likelihood as a manager of voluntarily guiding and disclosing that information for positive news, maybe not so much for firm-specific negative idiosyncratic news when it's like a market-wide slash in kind of CapEx. I don't think like, managers would say, well, look, I try to hide that, but certainly that's something we haven't really looked at yet.
Okay, but I agree with that. But when would you then expect the market to react, right? Do the market actually realizes this information when the earnings calls come out, or do they realize information when the analyst starts changing its opinion, right? So that's a different.
Yeah. No, that's great. So like, when we do those analyst forecast changes, you see like some of those like within days update their forecast. And I think like the market, so that's something kind of what we did, and I skipped a little bit over it, like, when we did this cumulative abnormal returns. Those were regressions from the end of day before the earnings call to the end of day 1, 3, and 5. And you did see like, within days, this kind of like information is incorporated in the earnings call. And it seems to be kind of coming from like the ChatGPT investment score, because we keep constant, at least the sentiment and the numerical earnings surprise. Now, of course, it could also be like, I invest a lot because my sales outlook is really positive. Partially the sentiment of the call captures that, but, I'm not saying that this pure full cumulative abnormal return reaction I could, would be comfortable fully attributing only to the investment score.
That makes sense. So Victor, I think we don't have so much time left, but you talked a lot about sort of also how you understand the models and so on. But is there anything or any kind of clear-cut case, so to speak, how you already apply that? Is there something, or is this sort of, are there still concerns also on the industry side to actually use that and deploy this large scale in their asset management, asset allocation processes?
Well, I think actually we do use it. The main thing is just to get a general sentiment type of factor. I think that maybe I touched upon it very, very briefly. I think that's the easiest. When it comes to corporate policy, we've been looking at M&A activity. That I think for us is the biggest. I have to say that is also something that I found so interesting when I read Michael's paper, is that there's a big overlap in what we do in terms of that M&A activity type of factor. Being it only that it's, of course, it's not a capex, it's not a dividend, it's not employees, but there are big similarities. When I talk to other people in the industry, I think building general sentiment factors around earnings calls, I mean, that has been already done for a pretty long time. It's just that these factors keep improving. That's what makes them so interesting.
Yeah, that makes sense. I think we need to close. I thank you both very much for basically being here and discussing this method. I think we're going to stay on for a few more minutes because I have a couple of more questions actually on my side. But before we leave, I just want to advertise the next webinar that we have. That's going to be in October. You can see here Alejandro is going to be with us to talk about whether large language models can actually trade. So that will also be an interesting use case. We're going to announce the industry discussant very soon. So I think from my side, thank you very much, everybody. Also everybody who participated, who listened to it, and hope everybody could take something away. I certainly did. So I look forward to our next webinar. Michael, Victor, again, thanks so much for being here. And yeah, and have a great evening, so to speak, right? Okay, thank you very much.
Thank you.
And everybody, of course, can also stay
Thank
in
you.
if they want to listen a little bit more. So Michael, just because honestly, I must say, I tried to replicate your paper a little bit.